FX-options. Cap downside, unlimited upside, and the reason EURUSD pins to round numbers. Here's the truth.
Euro USD trades at 1.0900. You think the euro is about to rip in the next 2 months. You buy a call, strike 1.1000, 60 days to expiry, premium 80 pips paid up front in dollars. 2 scenarios at expiry. Euro USD closes at 1.1200. Your strike is 200 pips in the money. Subtract the 80 pip premium, you net plus 120 pips on the notional. Euro USD closes at 1.0950. Your strike sits above spot. The option expires worthless. Your maximum loss is 80 pips of premium, nothing more. That's the asymmetry an FX option gives you. Spot FX is symmetric. 100 pips up, 100 pips down, equal P&L on the move in either direction. Options break that symmetry. You're paying premium for the right to walk away when you're wrong. And that asymmetric structure is exactly why on certain Fridays, Euro USD seems to magnetize to round numbers at 10 a.m. New York time. That's the product. The market it trades in matters as much as the math. There are 2 FX options markets and they look almost nothing alike. The big one is over the counter, the interbank market. Daily turnover around $300 billion according to the BIS 2022 triennial survey. Dealers, corporates, hedge funds, central banks, every contract bespoke, notional, strike, expiry, settlement, all negotiated directly between 2 parties. No clearinghouse. Credit risk sits between you and the dealer, sometimes papered over with ISDA agreements and collateral. You will never see this market as a retail trader. The minority venue, the part you can actually touch, is exchange listed. 2 exchanges matter. Nasdaq PHLX in Philadelphia lists cash-settled world currency options on 7 USD pairs: Euro, GBP, JPY, CHF, CAD, AUD, NZD, at 10,000 base currency units per contract. CME Group lists options on FX futures with standard sizes and weekly expiries. And here's why the venue matters. Listed options are centrally cleared. Your counterparty is the clearinghouse, not the broker on the other side. OTC options put the credit risk directly between you and the dealer. That's a structural protection that costs nothing extra, and it's the reason retail accessible options live on the exchange side. Clearing protects you from counterparty risk. It doesn't tell you what the option is worth on day one. That's the pricing model. FX options run off garman-kohlhagen. Black-Scholes adapted for currencies using 2 interest rates instead of 1 dividend yield. 5 inputs drive the price: spot, strike, time to expiry, the interest rate differential between the 2 currencies, and implied volatility, the market's expectation of how violently the pair is about to move. The sensitivities to each input are called the Greeks. Delta tracks price change per pip of spot. Gamma tracks how fast delta changes. Theta is daily time decay. Vega is sensitivity to implied vol. Rho is sensitivity to rates. Here's the trap most retail buyers walk into. On short-dated FX options around a central bank meeting, Vega dominates. Implied vol pumps higher into the announcement as the market prices in uncertainty. The Fed prints, the headline drops, spot moves your way, and then vol collapses. You can be right on direction and still lose money because the Vega crush eats the delta gain faster than the price reward arrives. That's not the trade failing on direction. That's the volatility you paid for unwinding the moment the event passes.
Which is exactly why corporates use these and retail mostly doesn't. A UK exporter with a $5 million receivable due in 90 days buys a GBP USD call near spot. If sterling rallies, they exercise. If sterling weakens, they let the option die and convert at the better spot rate. A German importer paying for machinery in yen buys a Euro JPY put to protect against a stronger yen. M&A deal contingent options that only pay out if the deal actually closes. Carry trade unwind protection. The pattern is consistent. Think of it like insurance on currency exposure. You wouldn't buy fire insurance unless you own the house. Corporates own the house, the underlying receivable, the import bill, the deal in escrow. The retail directional speculator doesn't. They're synthetically creating an exposure and paying premium for protection on a position they could just open and close in spot, with a stop loss handling the downside cleanly enough. For most directional retail bets, a spot or CFD position does the same job with less complexity and lower cost, provided you respect leverage. Options are the right tool when you're protecting cash flow you already own. They're usually the wrong tool when you're just guessing direction. But say you understand all that and you still want access.
3 channels. First, U.S. brokers with options approval. Interactive Brokers, Tasty Trade, TradeStation, and Charles Schwab all route to PHLX and cme-fx-options. Margin requirements and approval levels apply. Single contract premiums can run into the hundreds of dollars, even on a 10,000 unit PHLX mini. The access is real, it's just not casual. Second, outside the US, the menu shrinks fast. Saxo is the notable European name, offering vanilla OTC-style FX options to qualifying clients at dealer-quoted pricing. Third, and this one matters, binary or digital options platforms. Don't use them. The structure has negative expected value baked in. ESMA banned binary options for EU retail sale in 2018. The FCA followed in 2019. If a platform is selling you FX options with a clean 2-minute expiry and an all-or-nothing payout, that is not what I've been describing. That's a binary. Walk away. One more thing to check before you trade. Settlement type. Cash settled means you receive the in-the-money amount in dollars, default for PHLX. Physical settlement means you actually deliver one currency and receive the other, common on CME-FX options on futures. Forget to close a physically settled position and you trigger an unexpected currency delivery with funding requirements attached. And once you're in, the same multi-leg strategies that exist on equity options translate. Long straddles around central bank meetings, vertical spreads for capital efficiency, calendar spreads for vol term structure. None of them are beginner moves. Now the round number magnet from the opening. Here's the mechanism. Dealers who've sold options to their clients are typically short gamma on the resulting book. To stay hedged, they buy or sell spot as the price moves, dynamically, all day. As expiry approaches and a large option strike sits at a round number, 1.1000 in Euro USD, 150 in USD JPY, that hedging flow turns the strike into a gravity point. Spot drifts toward it. Sometimes it locks on. The 10 a.m. New York cut on a Friday with a big expiring strike at a round number is exactly when you see it. Not mystical. Positioning being hedged out in the spot market in real time. So, the verdict. If you're a US retail trader with options approval and you've put in the time on the Greeks, exchange-listed FX options on PHLX or CME are a legitimate tool. Bounded downside, centrally cleared, real product. Outside the US, your realistic menu is spot CFDs with proper risk management. And for most directional retail trades, that's actually the simpler choice. The line you do not cross is the binary platform calling itself an options venue, banned in 2 major jurisdictions for a reason. And whether you ever trade an FX option yourself or not, understanding how this market works changes how you read a Forex chart. Round number pins on expiry days, implied vol spikes before central bank meetings, dealer gamma flows on the cut. All of it is visible in spot if you know what you're looking at.
US traders with approval, FX options work. Everyone else, stick to spot CFDs. Full breakdown in the description.